Today's Talk About It Tuesday question is, since we're in the last quarter of the year, what should I consider about rebalancing my savings and investment portfolio? Love this question. That means we're getting a lot more sophisticated in our strategies for our investing. So first of all, let me define a portfolio because most people don't even realize they have a portfolio. So portfolio is just the collective of your savings and investment accounts. So what does that mean? Your bank account, any stocks you might have, individual stocks, or whether it's in an index fund, a mutual fund, an IRA, a TDA, a 401k, what else? Bonds, your any accounts that give real estate, that's really important. Also, if you have, what are these things? There's different vehicles, so many different vehicles, but whatever the collective is in terms of your body of investments and savings, that is your portfolio. I was thinking of peer-to-peer lending accounts because that's a big thing now too. And some of you have crypto. I don't understand why, but that would go in there also. So the collective of your savings and investment vehicles is your portfolio. And let me just talk about this rebalancing thing, because the mistake most people make is they usually only have one or two things in their portfolio. They're not well diversified. And what that does is it puts whatever you have at risk more great than if you had diversified. So let me explain that. In a portfolio, there's risk and reward. And what we usually chase is the reward and we ignore the risk. So what does that mean? If you only have a savings account, then there's very little risk, but very little reward. If you only have a stock portfolio, meaning a mutual fund, index fund, there's probably great reward currently, but there's a great risk because inevitably the stock market will decline. And during that decline, 100% of your assets will be at risk. So let me explain how that works. And I'll give you a perfect example. So in 2005, about 80% of my portfolio was in real estate. And if you were around then, you know that was the beginning of a real estate, or really the beginning and end of a real estate boom where the value of real estate was growing extremely rapidly. And so there was extreme equity growth. The moment you bought a property, you could pretty much turn around and flip it and make money. So I had 80%, like I said, of my asset allocation in real estate. And my thinking was, and I was young, this thing is booming. I'm going to buy as many properties as I can. I'm going to get as much equity as I can. And if I ever get into any financial situation, I'll just borrow against the equity in the properties. Now, that makes perfect sense if there would always be equity in a property. So let me give you an example of one property I bought. So I bought a property for $380,000, which was a decent price back then in New York City. And immediately, I tell you, within a month, someone offered me $575 for the property. I didn't take it. I was like, no way, because I was making money from rent, right? And so for me, it was about the rental income, not flips. So someone offered me $575, I didn't take it. Fast forward, 2008, there was a big crash in the market. So the housing market actually brought down the whole economy, and we were in a deep recession. 2009, I was like, whoa, I am in financial struggles right now, so I'll just pull some equity from the property. Banks were not lending because it was mortgages that actually drove down the market, so banks were not lending. They pretty much had shut down lending against real estate. So I said, okay, I'll just put it on the market. Someone offered me $575 a few years ago. I can probably at least get $500,000 for it. The biggest offer I got was $320,000, which was less than what I paid for it. So not only had the equity disappeared because the market was in shambles, I couldn't get out of it what I put into it if I tried to sell it. So I had to hold on to it. Of course, there's a happy ending to the story, but many years later, 2019, I ended up selling that property for $1 million. But in the meantime, when I needed the money, it wasn't available. So when we say the risk, it's not necessarily that you'll lose the asset. It's just that the asset doesn't become of value to you because you can't sell it or you can't borrow against it in certain markets. And that's going to happen repeatedly over time. So now, if you had decided that there's a certain risk reward you want, let's say you decided I'm going to put 50% of my asset allocation in the stock market because it's doing well. I'm going to put 20% in real estate. So now we're at 70%. I'm going to put 20% in savings. That's 90%, and 10% in bonds. And that's what you had decided as your strategy for the year. And now the year is pretty much over. We're in the last quarter, and you realize the stock market outperformed all these things, and so you realize you're 75% asset allocation in the stock market, and you hit your 20% in real estate, but you find that you're only 4% in savings and 1% in bonds. That's when you would rebalance. You would stop putting so much in the stock market so that you don't have as much at risk because, again, the economy goes in cycles, and we're probably at the end of that cycle where stocks are going to perform well because if we go into economic decline, which we're on the verge of, the stock market is not going to perform well. And again, it's not that you'll lose the money in the stock, but the asset value will go so low, you won't be able to use that money if you need it in a financial struggle. So what you would do in terms of rebalancing is like, okay, I'm going to stop putting so much in the stock market so that I can bring down my percentage there, and maybe I'll put more in my high interest savings. Or and because you met your goal with your real estate, whatever you did there, you're going to keep doing there, but you rebalance to try to hit your allocation. Or you say, okay, maybe the numbers that I projected in the beginning of the year don't reflect what I want to do now, but you still rebalance it in terms of what percentage is going to go in this investment vehicle, what percentage you want risk in that vehicle, and so forth. But I think you should use this time as a financial checkup straight across the board. I think you should also look at your emergency fund. Did I use my emergency fund? Did I not? Do I have a sufficient amount based on where I am today? Do I have sufficient insurance coverage for the things that I have at risk? Do I have sufficient income to carry me, right? Should I look at my budget and have my expenses gone up because of tariffs? Have my expenses gone up because of inflation? Do I need to now cut some costs and maybe find a way to increase income, right? I think it's a good time to do a total financial checkup and make sure that you're reaching your goals, that you're on point, that you're not putting yourself at too great of a risk right now, especially since we're in this very, very volatile time in terms of where the economy is going to go because of, again, tariffs, trade wars, the political climate, inflation. If we're looking at these things, where do I want my risk to be? Do I want to put more in cash right now, which might not be a bad idea? So I reallocate cash because there's less risk, even though there's less interest and less reward for it. There is far less risk if we go into a volatile situation, and I can easily access the cash if I needed it. So that's portfolio rebalancing in a nutshell, and that tells you the importance of why. But I'd love to hear your strategies. Have you rebalanced? Do you do it more than once a year? Some people do it annually. Some people do it semi-annually. Some people do it quarterly, which might be a little bit too much. But please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.